Hey, welcome to Grant's Interest Rate Observer of the Air. This is Current Yield, and I am Jim Grant. And with me, as always, is the great deputy editor of Grant's, Evan Lorenz. Hello, Evan.
Hi, Jim.
And Henry French, our fabulous sound engineer, is not on the premises, but he is with us at a distance today. We have a couple of very knowledgeable and scintillating guests. They are Michael and Samuel Ashner, and they're both in the commercial real estate business, which will be the theme of the show. In the meantime, Evan, do you realize that we are within minutes of the announcement of the Federal Reserve's decision that will change the course of the planets? And does the sun revolve around? No, it'll change the course of planetary orbits, possibly. Certainly the course of interest rates.
Yeah. Either Chairman Powell's going to destroy the financial system, save it, or do something in between.
You know, I remember reading something, I think was from the 1930s or 40s, and the economist, the very sound economist holding forth, said, we mustn't get ourselves in a position where the entire financial world rises or falls or hangs on the latest word of the central bank. That has come to pass. Nothing else counts.
Pretty much no. We saw a Bloomberg article a couple of days ago, and the headline was something like, $1 trillion asset managers fear missing out. And it was asset managers like Vanguard afraid that if the Fed gets into a pivot today and actually does not raise rates or perhaps even cuts them, then we might actually be off into a vertiginous rally in the stock market. And the worst thing you could do if we're in that is not to buy in the first day.
You got to be in the first day. Meantime, I don't know about you, Evan. I am sick and tired of this sunshine. And to change the mood, we have with us two of the premier practitioners within the five boroughs of New York City of the fine art of commercial real estate salvage style investment. These are people who, for a living, look for things that had been loved, laterally came to be reviled. However, in their being reviled, they may hold value. So welcome, Michael Ashner and Sam Ashner.
Well, thank you.
Yeah.
Good to see you.
Yeah, good to be here. I want to begin with the senior member of our guest team, Michael, and ask you, how do you see things in the real estate world, particularly in the city of New York, commercial real estate, and still more specifically, I guess, the value opportunities from things that used to be beloved?
I think you had to step back first. The term real estate, commercial real estate, is a generic term for various asset classes which have one thing in common: roofs, except for raw land, which doesn't even have a roof. All right. So each asset class, particularly now, in the last 20 years, has started to diverge, much like commodities. If I say to you, how are commodities going to do? You're going to, what are you referring to, Michael? Barley or silver? So we have to look at it in that light. There are a lot of headwinds in New York, a number of distinct headwinds. One, which is, I don't want to be political, is the regulatory environment. It is decidedly not in favor of commercial real estate.
This is the communism you're talking about.
This is a liberal progressivism.
Oh,
which
I was foreshortening that term.
ESG focused, which does not take into account the costs and burdens that it imposes on real estate, which are attemptedly passed through to tenants.
Right. I want to pick up on this non-political thread, and I want to observe some information we got from Maverick Real Estate Partners. Very thoughtful people, I gather. It's obvious they are from their materials. And says Maverick Real Estate Partners, in the past 4 years, real estate taxes on New York City rent stabilized buildings up 13%. Regulated rent growth up 6.4%. So call it twice the tax growth as the allowable regulated rent growth. Now, that is not a good way to make money.
Well, it's a little bit of a deceiving statistic, because operating expenses account for 50% of your revenue, should. So that would mean that your taxes have grown, your operating expense grew by a net of 3% against 6%. But nevertheless, operating expenses are clearly moving upward much faster than rent growth in New York. That's undoubted. It's just statistically, that's what the statement is. New York has seen that if you want to stay with multifamily, there's critical problems. few years ago, what was called the rent stabilization, whatever it was.
2019, Housing Stabilization and Tenant Protection Act.
So this has been a nightmare for New York, and no one wants to really confront it. What it's done is it said that for the 1 million stabilized apartments, if you want to it used to be if you put in $25,000 to upgrade an apartment in which someone had lived in for 30 years, you could get it back. I think it's like a 20% return on that, which is, by the way, not a high return because you have to upgrade the apartment in 8 years, 9 years in any event. So it's a sort of a market return on your investment. Now, the return is 2%. Now, why would I put $25,000 into an apartment to get a 2% return? The result, because the market wins all the time, is we now have 40,000 market affordable housing units kept offline. Landlords aren't going to fix the units. They just as soon hold them offline. So your problem with homelessness has been compounded by a progressive view that landlords make too much money or whatever it is, and we're not going to allow the market.
This is where I came in. I started at Barron's in 1975. And I think my first assignment was to talk to the people at the Community Housing Improvement. So CHIPS.
Yeah.
Right. And they were people who were fighting a noble rearguard and utterly futile, as it turned out, action against the institution of rent control. Short of high explosives, the most certain agent of destruction of bricks and mortar in the history of urban organizations. And this rent stabilization is a euphemism for a softer, I guess, kind of rent control, but still it is positively guaranteed to wreck the housing stock in time and to hasten the outflow of enterprising real estate people and others who want to make some money in business. And it seems to me not a healthy thing for the city or its credit.
I think that's true because it will bring down the tax base for sure, and it has. So, if one thing I love about economics or finance, it's a hard stop like physics. I can talk to you about social programs. I talk to you about this, and we can have soft stops. But economics doesn't allow for it. 40,000 units, which could be rented, are vacant right now. That's a hard stop. Will that increase? Absolutely. So multifamily is a troubled investment in New York City.
Sam, you have heard two gentlemen of a certain age going on and on about people getting off their lawn. Now, as someone who brings a different set of life experiences to the real estate business and to the real estate, I keep on calling it salvage. What's the more appropriate?
Distress.
Distress, yes. What do you think of the prospects for distress in New York City? Are you happy with the opportunity set that is unveiling now?
Well, actually, to your point about rent stabilization and what's occurred since 2019, Signature Bank, which obviously just failed and was acquired by New York Community Bank. New York Community Bank didn't take their CRE loan book at all. And about $11.9 billion of loans, which are now stuck with the FDIC, a large majority of which are loans on multifamily housing in New York City. The average origination date of those loans was in 2019, and the valuations attached to that were at a 4.5 cap rate. Now in the market, that's a 7.5, 8% cap rate. And widening still because you're not, to Michael's points, you can't raise rents. You can't squeeze any more juice out of the lemon. So in a way, I think it represents a generational opportunity to engage in distress investments.
Evan wrote a piece in the brand new issue of Grants about the intersection between bank credit and buildings. You can't have one without the other, right?
Yeah, especially the small and medium-sized banks that are getting, deposit runs right now. Well, the big 13 banks that, make up like 55% of all banking assets are the majority of the banking system. The smaller 4,000 or so banks that make up the other 45% of the assets do the vast majority of the commercial real estate lending. Now, the one benefit banks had coming out of the QE in 2020 and 2021 is the Fed had so stuffed them to the gills with so much money that they had more deposits that they needed, and they essentially were paying nothing on those deposits. Now we've taken the banks that had the most precarious balance sheets, engineered a run on them, and now we're getting kind of a run on a lot of other small and regional banks, which means that their deposit costs are likely going to go up. According to the Federal Reserve's latest senior loan officer survey, banks were already tightening commercial underwriting at levels last seen in kind of, the 2020 lockdowns and the 2008-2009 recession. So banks were already tightening. Now they're getting scarcer funding and more expensive funding. And it seems like that could potentially be the next hammer to fall in kind of the commercial real estate market.
Absolutely. I would say that the regional banks do engage in a large amount of CRE lending on new construction. You have Bank of the Ozarks, which engages in massive construction loans in South Florida. You have Axos Banks, which engages in office and multifamily lending. Silicon Valley Bank had a CRE lending book, a large part of which was wineries in the Napa Valley. I was listening to a different podcast earlier this week, political
There's
podcast,
more than one?
not an economic podcast.
All right.
And
I
they
guess
said
there's room
that
for one more.
we must save all the regional banks because everybody needs to talk to their regional banker and have a relationship with a local banker. And I think that's all well and good, but many of the more risky CRE loans have migrated from big banks to regional banks because big banks have much more oversight, much more stringent underwriting on their books for those types of loans. So it's troubling.
So to date, the problems that we've had in banks, first starting with Silicon Valley Bank, then kind of, metastasizing over to Signature and now First Republic, has been safe assets. They bought too many treasuries and mortgage-backed securities in 2020 and 2021 at yields so low that when yields rose, they essentially were, bankrupt on a mark-to-market basis. Is there a credit problem on the commercial real estate books that is going to start happening now? Because so far the problems, again, have been safe assets as opposed to, risky credit assets.
There are a number of problems.
I'll just make a generalized comment about the banks. It
Sure.
just strikes me. Short investors, they follow one another. So they all looked at these banks. They looked at the banks, the regional banks, and they saw that they were there long where they shouldn't be long and short where they shouldn't be short. And that was on treasuries and whatever it was. But now they're going to continue to look at banks. And what they're going to start to look at, because they see a vulnerability, is banks' real estate loans, for sure. They're going to come and say, why? And they're going to see evidence of that. For example, the Union Oil Bank? What's it called? The gas company.
Correct.
The gas company building in Los Angeles has a $300 million loan on it.
Yes.
Yes, held by an institution, which is now being sold for about $135 million. Now that institution can weather a $165 million book loss, but I'm not sure it's indicative of something a broader problem that other banks will have, and short traders will look at those, look into those portfolios. I think the problem with bank lending right now is it's a very tough environment for commercial real estate. Everything has gone wrong. It's more headwinds than I've ever seen.
It's capital intensive.
Is there too much debt at real estate? And the reason I ask is last week, Blackstone announced that it was not going to pay mortgages on a group of 10 offices in Las Vegas. And this follows other lenders like PIMCO, Brookfield, real estate owners who have great balance sheets and you wouldn't think have trouble paying loans, but they've, instead of trying to sell these buildings at distressed prices, have just returned the keys to lenders.
The underlying theme with all of those loans which you highlighted are that they are all encumbered by floating rate debt and they're unhedged.
Think of real estate as a very slow moving hedge fund. A hedge fund can get wiped out overnight because of its leverage, right? I mean, It gets called for its capital, it's done and gone. Real estate's not quite like that. It borrows money over a long period of time. It is hopeful that the value of the building when the loan matures is enough to roll over that debt, that circumstances should be relatively the same or better. But they're not. Right now, they're critically much worse. And they're much worse. There's a number of things you can point to. We start off with it, interest rates. I was making notes about the comparison to the great financial crisis of 2008. Well, interest rates didn't really move much. They were still 2-3%. Now, loans are at SOFR plus 200, 6%. So that right away means that lenders lend less because of the both loan to value and debt service constant ratios. They can't lend as much against that building unless that building has very low leverage. Separate problem when you want to roll over a loan, particularly a floating rate loan, is that your lender wants what? A swap, okay? What's a 2-year swap, 1-year swap, whatever. It used to cost, a year ago, maybe $60,000 to swap out.
Like a cap.
Yes. A 2% swap a year ago was maybe on 25 million, it was maybe $60,000. It's not anymore. It's about $890,000.
Wow.
So if you have a $100 million loan, not only is the lender going to ask you, say, I can't lend you as much. Not only am I going to want you to pay the cost of the restructure, but hey, I now need $4 million because I want to ensure that you can pay the rate. These are problems that we never had before.
Nor did we have working from home in 2008.
So that's of all of them, I can't figure out yet working from home. I am, as you know, a skeptic, but I think that the working from home, some businesses, people are going to come back. Law firms, your office is full today. People that are collegial, that have to meet, people come back. But other businesses don't need to come back. Tech firms, for example, they work from home. So I don't know yet the full impact of that. And when you say work from home, if the employer says, I want you in 3 days a week, well, you still need a space. So I'm not there are worse things that are facing office product than working from home. For example, when I started out 40 years ago, there was about 240 square feet of space per worker in an office building. Even before the pandemic, it was down to like 130 square feet.
Now it's 90.
Now, that's right.
So everything is like the IRT subway at 5 o'clock in the afternoon. Right?
Exactly.
Yeah.
Except now, so you start with that. In addition, there's been, I don't know, for example, in New York, probably 30 million square feet of new space built since 2018. So that's come online. That competes with the existing space availability. These issues are a headwind that we did not have in 2008.
Something else is the volume of commercial real estate mortgage-backed securities that are falling due this year. Very high volume, 2.5 quadrillion or billion.
I think there's 95 billion of non-bank mortgages backing offices coming due this year, but that's just offices.
And they're all running into refi risk right now.
Right.
But for bank refis, I think it's a couple $100 billion. I just don't know the number off the top of my head, but there's a lot of debt just coming due this year.
Most of the bank refis are going to be floating rate mortgages too, which is even more problematic.
Right. So this brings us back to opportunities for people in distress. So say I own a multifamily, which is a way of saying apartment building. I own an apartment building in New York City. It's rent stabilized, meaning the rents are capped. The operating costs are going up. I'm facing the necessity of putting in new equity because I can't borrow as much, and rates are going up, and the cap is going to be costly. Okay, so I'm not sure I want to do this. So I'm contemplating sending the keys back to the creditors. Now, where do you come in this process? Do you come in and say, we will lend you, we'll help you bridge this, Mr. Property Owner, but it's going to cost you 15%? Or do you come in and say to the lender, we can take this off your hands and make it work, but you're going to have to work with us on price? How do you proceed to realize the opportunities in distress in this burgeoning situation?
The key to distress is recognizing that everything for the moment has repriced. It's not the same price. So who can afford to pay to recognize that price change? Let's take multifamily in New York City. Well, I think that's going back to the banks before it's going to come to us because it needs to be dramatically repriced. I have both regulatory risk and I have operational risk. If you take, by the way, it's not, New York isn't alone. If I take the Southeast, I built an apartment complex. The banks looked at it very favorably. They lent them $200,000 per unit. It was a 3-year construction loan. Multifamily rent growth has not been quite what people expected. He's now got to refinance it. And instead of getting $200,000, he's getting $160,000. That fellow may come to us for preferred equity, for some sort of a restructuring. He's in a better position. But there is very often, whether it's office or multifamily, that it may well be that you're dealing simply with a lender who's got to sell the loan. Look what Brookfield did in LA. Here's the keys. You can have it back. Look at what's Columbia Property Trust saying. Here's the keys. You can have them back.
Isn't there reputational risk in this, or is real estate simply like amoral?
I think for them, it's the logical decision rather than throwing good money after bad.
Right.
And in the case of PIMCO, for example, it starts out a workout process as well. So PIMCO may end up in a better position now than they were, or they may give it back. It remains to be seen.
Aren't some of these newspaper headlines about jingle mail, like, is this a form of negotiation?
Yes, absolutely.
Yeah.
But it's not, the business isn't, if played correctly, amoral. It is the nature of the morality. If I fight with my lender and prolong it and draw out, have them give me money to walk away, that's reputational. That will be a problem. I have to disclose it if I want to go forward. But if I just give you back my keys on a non-recourse basis, people do that all the time. Simon has done it with countless malls. Vornado's contemplating it on a building. That is permissible behavior.
What's impermissible?
Impermissible is contesting the foreclosure.
Got it.
That's impermissible.
I'm glad there's something that's impermissible.
And bankruptcies also. Bad, very bad.
So I know real estate isn't one market, but according to Green Street, institutional grade quality commercial real estate fell 15% year over year. And that ranged from no change for hotels to down 25% for office. You said that real estate is a slow moving financial crisis happening right now. How far are we into the price correction mode, and how much more downside do you see in places like office or multifamily?
Well, it's two questions. Right now, we're well into the slow moving, becoming accelerated, because 2 years ago, a year and a half ago.
But still first inning.
I would say more than that. I think now we're in the fifth inning, because you're seeing default rates accelerate. You're seeing things in the news. Look, when Scott Reckler comes out on CNBC, it's a TV show that I'm sure you don't watch it. CNBC, and says that he may give keys back and he may do this and he may do that. That's not the kind of climate we had 18 months ago, even in the midst of the pandemic. So it is now, the turmoil is clearly accelerating. Now, what was the second question? I'm old.
How far into the process of price correction are we?
Just starting, because what I've seen over the years, my career, is three sort of phases in distress. First is, it's sort of like mortality, denial. It's no problem. It'll solve itself. The lender says that. The borrower says that. It's no need for a conversation. I still have 9 months on the loan. So we're out of denial. The middle is, how do we work this out? And how can we straighten it out? And can it be straightened out? We're clearly there. But the last part of it is parties recognizing where they are in the capital stack.
Take these keys.
And the lender said, and the interesting thing is this: much of commercial real estate, which was financed since 2015, was done with both a secured financing and mezzanine debt. So when you see that the default rate is 3 or 4% for CMBS style loans or first mortgage loans, that's misleading, because it's not telling you what the default rate is on the junior debt. The junior debt may be tenfold of that.
That's interesting. So
what are the current default rates on the junior kind of debt?
You can have 15% default rate.
No one really knows. You know it only because you follow UCC.
Doesn't TREP or somebody keep track of?
No, not that.
Because TREP only tracks the information on the first mortgages, and it'll let you know how much mezzanine debt there is and what the current rate is, but not the default rate.
Again, to return to opportunities, can you give us an example, for example, of a mezzanine loan that might come to you at 20 cents on the dollar that you find interesting and worth the risk? Have we come to anything that's causing you to want to do transactions?
Well, right now, there's a number of mezzanine loan portfolios that lenders have put into the marketplace. The mezzanine loan buys, the pricing is always attractive. It's the risk that is not, because mezzanine loans come with a senior lender, and you don't know how the senior lender is going to treat you if you accelerate the loan and take over. The senior lender may say, I'm money good. You bought it for 20 cents on the dollar. That's good for you, but I want to be paid off today. Now that's a problem, because if the credit market seize up on you, you're not going to be able to do it, and you're going to lose your 20 cents on the dollar. One lesson I've learned is that very inexpensive things can become very expensive very quickly. And much thought has to be given into all of the issues surrounding your effectuation of your remedies, how you're going to negotiate, how much money you're going to put in, frictional costs. It's not an easy business.
So time is a great consideration.
Oh, absolutely.
Absolutely.
Yeah, absolutely.
So does the time required to consummate a good idea lengthen during the final phases of the cycle, or does it foreshorten because people are finally ready to call it quits and to realize that things have come to such a pass?
It moves faster in the third phase. It does. Lenders particularly have come to Jesus, and they realize what the truth of their situation is.
Are bank examiners now helping you in that they are pushing people to recognize the facts, or are bank examiners just as alert as they were in the case of Silicon Valley Bank?
The issues with the regional banks will certainly help to accelerate these issues. When one bank starts to take CRE losses, they all start to re-examine their books.
There's an enormous herd instinct in regulatory behavior. the bank regulators will now start looking at loan portfolios much more closely. Now, there's a defense that banks have, but I don't know how strong the defense is. It's the same thing as treasuries. You have hold for investment and hold to whatever for sale. If they start pushing those loans into your impaired capital, that moves them into obviously held for sale. And that's the pressure that bank regulators bring on the banks after the overall global process has commenced.
So we're in the middle innings of kind of the mess that you see happening right now. How much money has been raised to actually go after the distressed opportunity in real estate? And what is kind of the reception from LPs when you actually talk about the opportunities that you think are coming down the corner?
So I would say in 2021, billions were raised for distressed opportunities. The great thing about human nature, and I consider myself a bit of a student.
You're human.
Yeah, is that everyone wants? Yeah, but I'm not.
I'm not that kind of human. No.
So
You
everyone
pass off as one very well.
everyone wants to talk about. I want to get in on the distress. I want to get in.
Let me at them.
So you show them. You bring them a deal or a series of deals, and I don't know. The market's rocky right now. I got to turn my money into cash and gold. I don't know that I want to do it. I'll wait a little bit. I'm catching a falling knife. That's human nature. There was, I always wonder what happened to all of that cash that was in private equity in 2007. Where did it all go? It didn't come to bail out real estate. There were very few distressed purchasers in 2000. Winthrop, the public company I ran, was the most active buyer of any of investment real estate and paper in 2008 through 2013. And we were a tiny company. Everyone else was battening down the hatches, or they didn't want to invest. This is
brokers loved us.
Yeah, but this is
lots of hockey tickets.
It is. My analogy is that when markets start to move upward, everyone slowly walks into the room and grabs a chair. When somebody else fire, they head for the doors and they don't come back in quickly. So I'm not seeing the deployment that I used to see.
Let me ask you about possible problems, and one of them is the structures that are best known by the brand name of the biggest such entity, B-REIT. This real estate investment trust that Blackstone has brought to market and has made a great success of. People want to get out. More people want to get out than are allowed to get out month by month. This is well disclosed to the investors, but still they are queuing up. And there's more than one such B-REIT in the world. And is this going to be, I don't know, is this going to be the source of additional problems, or is this well recognized in the market, been discounted?
Let me ask a question. Let me respond to a question with a series of questions. I can buy Vornado stock, I believe a great office company. I really do. I can buy it today, tomorrow, in, out, whatever it is. I pay 3 cents probably too much to my broker to buy a share of stock. I buy B-REIT, and there's a 4%, 5%, 3% commission. So I've already lost, and that's, if I add in acquisition costs, whatever, my dollar is turned into 95 cents. So I'm behind the 8 ball. So if I don't think that the B-REIT people have more IQ points than other, substantially that much more, they do, because it's hard to get a job at Blackstone. But if they aren't that much smarter, then their buying is not going to offset by that much the haircut that you take going in. So, but we're in the deal now. We are in B-REIT. Now, everywhere, all of the pundits and financial analysts have said that equity in REIT and real estate has gone down, to your point, 10, 15%, whatever. Nevertheless, they've marked their real estate to actually close to a 25% premium to the purchase price per share. I don't know. That strikes me as odd. Why would one be doing 40% better on its equity returns than everybody else in the public markets? I tend to think the public markets are they may overcorrect, but they're pretty savvy as a general rule. So when you add illiquidity with, I can't understand the underlying financial underpinnings which justify an increase in value of, 30% over 3 years, whatever it is. you get uncertainty, and people who are locked in now want to leave. That's what happened.
So related to B-REIT, it wasn't just B-REIT buying kind of, trophy properties and, gateway cities. That had actually been a winning trade for sovereign wealth funds, for insurance funds, for pension funds. Buying office buildings in Manhattan at like a 3% cap rate was viewed during the era of 0% rates as not only a bond proxy, but a bond proxy that gives you like inflation hedging because supposedly rents go up over time. Of course, that's turned out not to be true, but you do have all this institutional money that bought so many trophy properties in gateway cities. Are they going to dump it at some point? And what does that happen? What does that mean?
Well, in the case of B-REIT, they'll have to dump it because you'll get enough redemptions and
Yeah.
you won't have any other choice. And there won't be enough pension funds that will bail out B-REIT investors like they just recently did, obviously.
Sovereign wealth funds they're multi-generational. They don't have to dump anything. That, in fairness, that is your anti-dumping
Well, and
floor.
also in fairness, the B-REIT people will tell you that illiquidity is our gift to you, impulsive and suggestible retail investor. We have generated what is over the course of time, we generate 8.5% per annum, some more than respectable returns. And we are helping you not to pull the trigger. Just stay where you are, and we'll continue to do what we've done.
Well, I understand that kind of mantra from the federal government telling me how they're helping me. I've never quite, apart from my parents, I've never heard that from anyone else. They're helping me and guiding me in my investment decisions. Look, I do think the people at Blackstone are very smart, but if you look closely at it, even their investment philosophy has changed. So now the big B-REIT is buying debt, it's taking debt positions. It's not what they, I think, wanted it to be. They've bought companies, small REITs. They do have this. They have a lot of capital, all right, and they have the ability to source a lot of capital. And in my experience in real estate, location's important, but timing, duration. If you can hold, and it's the decent product, you generally can get out at some point because of inflation, because of events that wind that turns to your back. So those people can hold. But here's who can't hold. Let's take a syndicator. A guy in New York or LA who has 20 deals, and each deal he raised $40 million or $30 million, and he bought a $200 million building, and he levered it as much as he could. And now the market turns against him. He doesn't have a currency in which he can raise, to bail these buildings out. He's not a sovereign wealth fund, which has oil that it can put in. He's got 20 bad deals. Or if he's got 15 bad deals and 5 good ones, the 5 good ones can't help the 15 bad ones. That's where you see the real stress of and equity holders is that kind of investor.
How much of the market do you think that kind of investor makes up? Is it just kind of like the small tails? Are they like a relatively large proportion of the market? Like, is this something?
No, that's a decent player in the market. They're not, they're not the biggest, but it's look, there are a lot of buildings in Manhattan and Chicago and Los Angeles. I would say a third of which are owned by that sort of investor.
Yeah.
What are you guys bullish on?
Bullish on what? What way? Bullish. I've never been bullish on anything.
Okay, what are you neutral toward?
Okay, neutral. I'll tell you what I think. What is safe? I think that ultimately what is safe is multifamily, because people will always need a place to live. While multifamily evolves in the design of the units, the composition of the apartment complex, whether it has one, studios, whatever, that's always changing. But multifamily, people need a place to live.
But is there saying that food companies are safe because people always have to eat? I mean, getting back to bonds for a second, the wise ones used to say there are no bad bonds, only bad prices.
And bad timing.
Right. So let's go back. Let's go back to this.
So multifamily. Look, we haven't used the R word here. Of all the things we've talked about, commercial recession. Recession is. That affects real estate dramatically. It will affect multifamily adversely, because what happens is there's a very high correlation between job formation and household formation. But nevertheless, if you're asking what I'm neutral towards, multifamily I think is.
But in New York City, a multifamily since 2019 is down, 40% on average?
Well, hold on.
We like it at the right basis.
No, I'm not certain, in fairness to your point, I'm not certain. Market rate multifamily in New York, okay? But even there, the regulatory environment, we don't know what's coming down the line with good cause eviction. These are very problematic. And if you're in the industry, you know that these are things of concern. I'm restricting how I can increase rent, even in a market rate apartment. I have to justify I now have to justify why I don't want to rent to someone, apart from the constitutional reasons. I'm talking about because of credit problems, because of criminal history. This is not good, all right? But when I think of multifamily, I'm thinking about all the markets elsewhere in the country. So I say I'm neutral on, well, you would say neutral, on warehouse. Logistics, you know what? We have changed. The economy has changed, and we are much more dependent on delivery services and whatever. I think it's overpriced, but I am neutral on that. I think that right now you're seeing a growth in the vacancy, and that's because of the recession.
We also like retail, especially neighborhood retail.
Strip centers.
And if you're in a suburban area, people still go to the nail salon and the dry cleaner. And they did during COVID. Kimco owns a lot of that, and it's a great company. They don't have any large single tenant exposure. And as a result, they have a great portfolio of real estate with, small tenants here and there.
Yeah, I think that strip center retail is solid. Okay. And I think Americans will always hopefully create new small businesses. There'll be replacements for large-scale retailers that go out of business. Milton Cooper, who is a phenomenal person and is really a star in our profession, founded Kimco. I asked him one time what he thought about the retailers, and he told me, I think it was 85 then, he says, 30 years ago, there were 150 publicly traded retailers. Only 3 are left. So the business, what he has learned from the business is he's always able to replace that tenancy. So I believe that retail is a good long-term investment, and you won't see much distress outside of mall retail. Now, I don't think you'll see much at all. Specialty use, I don't know. Not for me. Bowling alleys? Take back the bowling alley. What am I going to do with it?
Have we talked about, not talked about something you would like to get into?
Los Angeles stealing the economics.
I'm sorry?
Los Angeles stealing the economics of buildings.
Oh, you want to talk about this? The new Los Angeles law on transfers of real estate.
All right. So
it's a taking. Really.
This is like a quiet, unknown sinking of real estate in Los Angeles, and I think San Francisco now also. They've imposed a 5% transfer tax on the full value of the real estate when it's sold and when it's foreclosed. Let's think about that.
Regardless of whether or not you made money on the investment.
Doesn't matter. So yes, exactly. So let's think about that. You bought a building for $100 million. Okay, you put on $70 million of debt. All right. Someone says to you, okay, look, I'll buy it from you for $100 million. So you think, okay, I'm getting my money out. You're not. $5 million. You lost $5 million in that trade. Want to make it worse? The lender forecloses on the building, takes it back. Now it has to pay $3.5 million transfer tax because there's a trade there. Now it wants to go sell the building, and whatever the price is, it pays another 5%. This, since equity is inherently levered and it's a smallish portion of the capital stack, a 5% transfer tax has enormous impact on real estate values.
And for real estate lending, because if you're going to be engaging in any sort of real estate lending there, it's not clear whether or not you have to pay the tax on a foreclosure. And if you do, then you basically have to pay the tax twice, when you foreclose on the real estate and when you sell it again.
Yeah, I'll give you an example, interesting, which is in New York. If you want to understand contortionists, so in New York, I think it was a 2% mortgage recording tax. So what happens in New York, no one wants to pay the mortgage recording tax. So what they do is you put a mortgage on a property, right? I buy the property. So what I do is I buy it subject to that mortgage and then rejigger the entire mortgage as a new lender so I can avoid paying the mortgage recording tax. I use the same document, even though the terms of the new document
with whiteout, right?
We get out a typewriter and we just type over the old letters and numbers.
So that is.
I wonder, gentlemen, if we can draw lines between these property tax, the attacks on the tax base through these evident attacks on real estate, connect that to municipal creditworthiness in cities like LA, Chicago, and New York City. is this going to redound to the detriment of the municipal
Sure.
credit?
It absolutely will. And I've actually tried to explain this to 2 New York City councilmen before, which is that you're decimating your property tax base, which is how New York City gets most of its revenue. Why would you do that? It's a terrible place for cities to end up, and it's going to cause, to your point, a lot of municipal finance issues.
A couple of issues ago in grants, we wrote a piece called In the Absence of John Galt. John Galt being a hero of Ayn Rand and Atlas Shrugged. And John Galt was the enterprising fellow who disappeared from society because he was no longer going to put up with rent control and such things. And he went out to, I think, Colorado and founded a gated community, golf courses, and others joined him. And so this was that was the theme of the book. But it seems to me this kind of thing is happening in New York City, and the tax base is being chipped away through such things as the 2019 Housing Stability and Tenant Protection. Ladies and gentlemen, you see this? The quotes, air quotes, Protection Act. So they're protecting the tenants from 40,000 apartments that they can't rent. But I don't know.
But I think you have, look, New York and California. If I look at those 2 states, everyone's going to move to Florida and Nevada. The taxable burden on the population in ththose states is so onerous, and it's only going to get worse. The fact that Kathy Hochul pronounces, I'm not raising taxes. She didn't say the other part, this year, right? You have this huge outflowing of income streams to the state into other states. This doesn't bode well.
And for corporations that leave California, the state is now going to try to go after them retroactively for taxes, which is, they want essentially an exit tax from California if you move to Texas or Florida.
40% of the city's revenue comes from real estate taxes.
Yes, it is. All right. Sam, thank you for being here.
I have a question. I have a big question. So what do you think about the new rules in baseball? I know you're a fan.
I was thinking when Sam, you were saying the 5th inning, maybe you were saying the 1st inning, and you were saying I was thinking
we were actually talking about the same inning.
Is that adjusting for the new clock because it's moving faster? You know, I am for it. I sometimes, gentlemen, I am not a great sleeper, and sometimes I put myself to sleep with the lullaby of radio recordings of World Series games from the 1950s. That's when I was 30 years old, and I have fond memories. And those games were over in 2 hours and 12 minutes. There was no clock. That was just the way things worked. And so this, to me, is the unusual, if not unique, example of a progressive reform that is actually conservative. So I'm in favor of it. Anyway.
Well, you asked quickly if there was anything you thought I wanted to mention. And I would say that while we're bearish about many things, this represents, to my point, a generational opportunity in real estate investment. For me, I have a few more generations than Michael does, but Michael's been through how many cycles now?
4.
Yeah. So the blessing of getting to work with your father every day is that, I get to use his IQ, and he gets to remind me of things.
I get
times like this.
I get
So
to make
nothing ever changes, does it, Sam?
I wouldn't have it any other way.
Everything's the same except how it changes. I get to make all new mistakes. All right, thank you.
Michael Ashner, Sam Ashner, thank you.
We were honored to be here.
Well done. All right, talk soon, fellas. Hey, we want to know what you think and who you'd like to hear from. So if you have an idea for the podcast, please email us at podcast@grantspub.com. That's GRANTSPUB. And publication, pub, saloon. Go grantspub.com. Thank you.